Good morning, and welcome to the Energy Perspectives Group webinar hosted by Kolibri Global Energy. This event is being recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here is Dan Steffens, who will introduce today's speaker.
Good morning, everybody, and thank you very much for attending. I hope you can hear me well. I'm not using my headphones for this one. I got a brand new computer with a new camera, so that's why I'm on here. And it looks like we're at the offices of Energy Perspectives Group with my background there, but anyway. So anyway, today's webinar is hosted by Kolibri Global Energy, one of the companies in our small cap growth portfolio. The company's production increased by 68% year over year in 2022 and another 77% year over year in 2023. All of this growth has been generated by their successful drilling programs. Based on the midpoint of Kolibri's 2024 guidance, which was provided on January 29th, the company's production should increase another 29% year over year in 2024. I've been following the company for about a year and a half, and I just want to give you some of the key points of why I put it in our small cap growth portfolio. For its size, Kolibri has a significant amount of low risk, high return development drilling locations. I refer to this as running room. If you're new to EPG, you'll hear me say running room a lot, and that's their inventory of development drilling locations. And they have it in a very good place, central Oklahoma, that's got a lot of takeaway capacity and plenty of room to hook up new wells. They have 180 potential drilling locations, 60 proved, 63 probable, and 57 possible for horizontal drilling locations within their acreage in the Tishomingo field in central Oklahoma. And all of those locations just are in the Caney formation. Below the Caney is the T-zone and the Sycamore zone, which have not yet been included in any of their year-end reserve reports. Really important fact is that the 17,000 acres of leasehold that they have in the Tishomingo field is all held by production. That is a very significant value and very important if they'd ever want to sell the field or the whole company or something. But based only on total proved reserves at 12/31/2022 of 33.3 million BOE, 75% of was light oil. The company's PV10 net asset value is over $13 US as of based on their 9/30/2023 balance sheet. They probably will report more proved reserves at the end of 2023, but the PV10 value might go down because of lower oil and gas prices used by the SEC. Anyway, I calculated that about 92% of this year's revenues for 2023 were from oil sales as a result, basically because the gas prices were so low. But to me, the key to my stock valuation are three things: steady annual production growth, funded primarily by operating cash flow, lots of low risk development drilling location, years and years of drilling inventory at the current pace, and the potential for a shareholder return program pretty soon. So today we have two of the company's officers on our panel, Wolf Reniger and Gary Johnson. Wolf Reniger brings over 36 years of conventional and unconventional E&P experience at the company, most of the time in senior management positions. Prior to joining Kolibri, he served as Executive Vice President of Bankers Petroleum Limited and the President of its wholly owned subsidiary, BNK, that was spun off in 2008 and became what is now Kolibri. With an extensive operations and finance background, Wolf has been at the forefront of BNK Petroleum's acquisition of unconventional gas projects on an international scale and development of the company's Tishomingo field in central Oklahoma. He holds an economics degree with an emphasis on computer science from the University of California, Santa Barbara, and has served on the board of directors of the California Independent Petroleum Association for over 25 years. Gary Johnson is the CFO. He's a CPA, brings over 30 years of accounting and finance experience, 20 years in the energy industry prior to the company. And prior to joining Kolibri, his career has included roles with Occidental Petroleum and Director of Technical Accounting, where he was responsible for the company's public filings and worldwide accounting compliance. Gary graduated from Loyola Marymount University with a Bachelor of Science in Accounting, and he also holds an MBA from Auburn University. So with that, I will turn it over to Wolf to make the presentation.
All right, thank you for the intro. Thanks everyone for joining us here today. First of all, I'll go through the forward-looking info. This you can find on our website here and on our presentations as well, our disclaimers, and then a lot of disclaimers on the non-GAAP measures that we talk about routinely, as all the other oil companies do as well. But getting into it, just kind of a group here. You'll see our market cap right now. We're trading just a little bit lower than what our share price assumption here is. We have about 35.6 million shares outstanding. US market cap 114 million. Enterprise value of about 130 million from net debt of based on our third quarter 2023. And you can see that our debt to adjusted EBITDA is at 0.66 back in from September of last year on third quarter, and our enterprise value versus proved BOE of $3.82 per BOE, so cheap on a per barrel basis. Comparing that all to what our reserves value is, and this is from the end of 2022. This is the last report. Our year-end 2023 reserve report will be out sometime in March. But proved reserves of 33 million BOEs, $515 million compared to our market cap of 114 million, right? So big difference here. That's one of our value propositions for the company overall. Dan kind of covered where we are. We operate through our wholly owned subsidiary, BNK Petroleum US, which was the old company name before we changed it to Kolibri. But this kind of gives you an overview of the property in full. I'm not going to go into this too far, but what I will stress is this was, again, at the end of 2022, our proved reserve split. So how much of our reserves are proved and how much are proved undeveloped, I should say, versus proved developed producing. We only had 18% of our reserves at the end of 2022 in a proved developed producing category. So like Dan said, a lot of running room, even on just the proved side of things. And that was up 10% from the previous year, where we were only at around 8%. So we think we have everything put together, drilling wells in a low risk manner in the area that's well defined. And I'll go into some of those details here. A little bit of history for those of you that are new to the story. Apologize to those that know the story well. But where we are, we're in Oklahoma. As Dan laid out, we're about halfway between Oklahoma City and Dallas, outside of Ardmore, if we know where that is. And all around us, you'll see here is Exxon. So we originally drilled out here, we had about 12,500 acres, and we were drilling for the Woodford Shale, which some of you may have heard of. It's mainly a gas play. So back in the first days, when we were drilling out here, we were drilling down through the Caney and into the Woodford, and I'll explain why that's important. We drilled around 40 wells across our 12,500 acres. Most of those we were operator on, and Exxon started buying out everyone around us, and we held out, and so we were the last company to hold out to be sold to Exxon. You can see that they've got about 250,000 acres down here, and we were the last holdout with our 12,500 acres. We ended up finally saying yes to Exxon for $147 million, but we retained the rights to the slightly shallower Caney Formation and Upper Sycamore. No one else was able to do that. They wanted to consolidate the entire Woodford play. But you can see here, the Woodford production at the time, we were only about 15% oil. So the rest was gas and natural gas liquids. And so what's happened since is that we started producing from the Caney, which is slightly shallower. It's only about 300 feet shallower, but it has a much different profile on production. As you can see here, at the end of third quarter here, or in our third quarter production, I should say, we were about 76% oil. And gas was only about 10% of our makeup, 14% was natural gas liquids. And so really we converted from selling a natural gas play on the same property, coming into and turning into a more of an oil producer where natural gas prices don't really affect us very much. That's a very minor portion of us. The gas hire obviously makes a little bit of money for us, but really what moves the needle for us is oil and then NGLs also to a degree. Plan for 2024 is continued development of the field in the Caney. Down here, a small picture of the Caney. Down in the bottom here is where the Woodford would be down below the Sycamore. So forecasted production growth in 2024 over our 2023 guidance, just because our financials aren't out yet. They'll be out sometime in March. Then we'll be able to tie that down a little tighter. But nice growth again for 2024 is what we're projecting. Second quarter activity coming on. We're drilling and completing, plan on drilling and completing 2 Caney wells. And then in third and fourth quarter, drilling 3 additional Caney wells and completing those 3 wells together with 2 wells that hadn't really been drilled. One at the end of, in December, I should say, at the end of last year, and one in January. The reason for the delay on those really is we want to, later on in the year, we were going to fracture stimulate these wells that are in that same area. And when you're fracture stimulating wells, it does have an impact on an offset production sometimes on offset wells. And so we want to minimize that. And so we'll do all those at the same time so that we only impact those wells by shutting them in and then having to dewater them again once rather than doing it twice. So we have spent some CapEx that we'll get into later on in the year again. But that's why those wells weren't completed right away. Then we also last year had drilled 2 wells testing this T-zone, which is technically part of the Caney, but we saw a frac barrier that was in between the Caney and the T-zone. And so we earlier in the year drilled 1 T-zone well along with 2 Caney wells, where we placed 2 Caney wells right here, let's say, and then like a T-zone well just below it, splitting the difference between the 2. And those wells performed well. When we did that again later on in the year, after taking a break and not drilling a T-zone well, just drilling some Caney wells, so we got the data from the first set of wells, we did see a potential impact from completing these wells at the same time, where the T-zone probably interfered with some of the Caney, and we had way more fracture stimulation fluid that went out into the Caney, and thus affected some of the Caney wells for a longer dewatering. So we're going to hold off on drilling the T-zone wells at the same time. And we're still gathering data, though, to figure out in what parts of the field maybe we drill them all at the same time. But our gut feel kind of right now is that we'll probably develop the Caney. And then once those wells have been drilled and completed for a few years, then we can come back in for the T-zone, complete that. And even if it pushes up into the Caney a little bit, then you just get a re-stimulation up here into the Caney. But we do think the T-zone in the long term is going to add locations as well. And as Dan said, there was 0 credit given on our reserve report for the T-zone. It was all for the Caney as it is. With that, I'll turn it over to Gary. He can talk about our forecast a little bit.
Thanks, Wolf, and thanks to everyone at EPG for joining the webinar. So I'm going to review the 2024 forecast that assumes the drilling activity that Wolf just discussed. As we continue to develop the field, we are forecasting continued solid growth in production revenue and adjusted EBITDA in 2024, which is on top of the 2023 increases that we forecasted last year. So let me get to the forecast. All amounts are in US dollars, and we used a $72 oil price for the entire year. So we're forecasting average production for the year to be between 3,500 and 4,000 BOE per day, which is an increase of between 25 and 33% from our 2023 guidance. Revenue for 2024 is expected in the range of 60 to 65 million, which would be an 18 to 23% increase from the 2023 forecast. We are forecasting adjusted EBITDA to be between 46 and 51 million, which is an 18 to 24% increase from the prior year forecast. Capital spending for the year is expected to be in the range of 33 to 39 million, And our net debt at the end of 2024 is forecasted to be between 25 and 27 million. And lastly, the 2024 forecast of enterprise value to adjusted EBITDA is in the range of 2.56 to 2.83. And it's not on the screen, but we did announce a shareholder return policy during the year, or that we would consider a shareholder return policy during the year. And I just wanted to mention that the current forecast does not include the impact of that policy, since nothing has been approved by the board yet. And now I'll hand it back to Wolf.
Oh, thanks. And here's a graph also on the right-hand side here, shows from where we've come from 2021, being down about 6.5 million on adjusted EBITDA, and the growth that Dan talked about. So we're looking at solid growth for the company going forward. Sorry.
About 600% from 2021 level. So.
And then just to go a little further on a quarterly basis, showing the production growth, right? So this was where we weren't drilling any wells for a number of years, when oil prices were down, and we were not drilling any wells for a few years, and this is where we started drilling wells again. And so you can see that production is growing nicely, showing the same thing on an operating income side of things. And we showed the operating income here in these lines, but also the red, which shows you the oil price. So even though oil prices, had peaked, in second quarter of 2022 over $90 a barrel, somewhere between 95 and 100 is my guess. Just eyeballing this, as oil prices have still come down, dropping down to around $60 in the second quarter of 2023 and coming back up in the mid 60s. You can see our revenue, operating net income is still growing. So even though oil prices have dropped, we're still showing growth on an operating net income basis. And I'll go into that a little bit on some of the metrics, what caused that for us. The infrastructure is all in place here for the field. The gathering system is less than a mile, generally quarter mile to half mile from all of our approved locations. We had a gathering system that we owned about a third of. Exxon ended up owning about 2/3 of it by buying out other producers in the field and in the area. And when we sold the Woodford Shale to them, they consolidated the gathering system. So our third was part of that sale, which makes it easier for one operator to operate the entire system. So we worked out a deal with them where we paid them a gathering and compression charge. They sell and market all of our gas and natural gas liquids because it's a wet gas gathering system, and we get the same prices that they get. So, given that they have a good sized marketing department, we're hoping that they maximize it more than we could in general for gas and natural gas prices. So that works out well for us. All of our oil is trucked out of here. We get WTI less about $1.85 a barrel. And the netbacks are good, and the differential has been really consistent in that number of $1.85 a barrel. So we don't have some of the issues that other operators have in other basins where sometimes they get paid close to WTI, sometimes that they get paid a whole lot less than WTI. It's nice being in the middle of Oklahoma. As Dan mentioned, we had lots of locations. We have 180 booked Caney locations at 6 wells per section spacing, which is what Netherland Sewell has assumed. At the end of 2022, there were 60 proved locations, 63 probable, and 57 possibles. That's on 17,000 acres, or we have 17,000 acres. They didn't evaluate all that acreage. We still have some acreage off to the east that is not part of this reserve report, where in the future we can also expand that. Obviously, we need to drill some Caney wells over there for us to get credit for it on our reserve report. We only speak about our reserve report in general. 29 wells on production. Acreage is 88% held by production. That's over our entire acreage block. So when we speak about having a high percentage held, that's even higher. It's like a 98% for the acreage that we have in the reserve report. So very low risk for us having to drill wells to hold production. And then, as I mentioned, upside from the T-zone. Now, ultimate recoveries. This is based on Netherland Sewell reports. Over the years, this to me demonstrates reservoir quality. So early in the production cycle, you know, they're more conservative on what these wells will produce. You'll see some people go into fields and start drilling wells because the first year they say, okay, you know, we think it's going to produce this much per well. And then as they get more production history from these wells, they realize they don't stay up as long, they fall off faster. And the ultimate recoveries from these wells are actually less than what they think it's in the first year. So for us, year after year, Netherland, Sewell has been increasing the reserves. So you can see that the reservoir quality is holding in there very well and holding up. Difference between infill and this is because some of the older wells that we've produced have produced way more, or they expect them to produce, I should say, way more than what they're estimating from the average spacing unit for the wells. So they decrease the offset wells in order to make up for that, because, you know, when you have a good chamber and one well produces a whole lot more, so they reduce how much you're going to produce from those other wells. But that's why you'll see our infill in some of these areas are a little bit less from Netherland, Sewell. But in these areas, if you look at this, this is what is originally in place, and they believe that we can recover. Drilling efficiencies. So we've gotten better and better at drilling wells. These are days across here, how long it takes us. And this is the depth of the drilling. So remember, we're going down, we're at about anywhere from 8,500 down to about 10,000 feet. And then we go horizontal for 5,000 feet or so for a 1 mile lateral. And so that's why you see it coming down. And then for the full like 15, 16,000 foot wells on average. These green lines are our history of wells, of how long it took over the years. In 2016, we were, you know, 29, 32 wells in the early days. Got better in 2018, better in 2022, better in 2023 for an average of 18 days. Last two Emery wells were an average of 11 days. So this was the second to last well where we started a new downhole assembly, and this well part of the way through it. And then we did this downhole assemblies changes in these wells, and that's where it ended up being really efficient drilling for us. And our team did a great job on this. Forecast coming in on a cost basis, and this is drilled, completed with the infrastructure in place on the surface, the facilities. So this is complete through hookup. Our forecast was for 7.2 million per well. And the last two Emery wells were drilled and completed with facilities for 5.4 million. So really had a drastic price drop. You know, we strive for constant improvement. We try new things, hence trying things in this well where we tried two different downhole assemblies. One of them worked really well. We stuck with that. That's how we improved. We did the same thing on the natural gas, on the fracturing side of things, excuse me, on the completions, where we were making better and better wells because of it. Going back to valuation. So enterprise value to proved reserve value, when we take our year-end 2022 reports, compare that to other operators. These are Canadian producers that are, you know, closer to our market size, trying to stay in the same realm as close as possible to us. The reason that I have used Canadian ones is because a Canadian reserve report uses slightly different pricing than the US report on the SEC case, where they use a flat average price on the SEC case. There's an escalated case on the Canadian side of things, which frankly is probably more realistic in the long term. So that way we're comparing apples to apples. You can see we're much, much lower on a valuation comparison to our peers, where the average is about 44%. So just to catch up to everyone else, you know, our price should be increasing quite a lot in order to get up to our peers on a proved reserve basis. As Dan mentioned, on a per share basis of valuation, on the 1P value, you know, US, which would be around $14 a share, we're getting full value. On a 2P proved, and that's a proved probable case with a 10% discount NPV, it's closer to $20 a share. And, you know, February 2024, we're trading around, you know, 318. I think we're a little lower than that today. I think we're around 308 or 310, something like that. So long ways to go. Now, valuation wise, why our cash flow is good, why you can see we're going up, is netbacks. So comparing us to these other peers, where our netbacks are, meaning how much we make per barrel of oil equivalent that we pull from the ground. We're at about $40. This was in the second quarter of 2023. We need to update that to third quarter, but you'll see similar trends. Much, much higher than a lot of the peers that were there. Oops, let's go backwards one, sorry. There we go. Much, much higher than that. And so we make more on a per barrel basis than a lot of our peers. Our G&A has been going down on a BOE basis over the years, so that's all checks out. And then our operating expense, which is, you know, netbacks, the previous slide is basically a combination of what you get for your oil. So you don't, if you have a big differential, you're not getting as much for your oil, and how much your operating expenses are per barrel. And so same thing, we are down on the very low end. We're not the lowest producer here on our peers, but when you look at it, these three peers are actually mainly natural gas producers. So, you know, they don't have much in lifting costs. Gas more or less flows out of the ground, and that's why theirs is lower. But in general, we are very low on our operating expense side of things. So that helps our productivity. So when we compare ourselves on a enterprise value basis, I'll make the case that we should be trading higher than the average because our netbacks are better. So I am able to compare SEC calculated operating netbacks to the US comparisons. So a lot of our peers, and really we're much higher on that too. Not much higher than the best companies, right? We're still in that range, call it the same, but a little bit better. But we're on the upper end of everything that other operators are doing in the US as well. And then I just put a slide in as a reminder, our yearly net revenue on a yearly basis, you know, 2021, close to 20 million, close to 40 million, 2022, our forecast is around 50 million, call it just over, and growing to, you know, probably 60 million is our forecast for 2024. So nice growth going forward with a lot of running room, as Dan said. And this kind of just sums up everything I said today, including what Gary said, that the board will consider a shareholder return policy in 2024 as the year goes on, and be subject to obviously things performing like we want them to, and you know, oil prices being at least in the 70s and hopefully start climbing from here as well. With that, that's really the end of our presentation. So if anybody has any questions,
yeah, good job.
Good job. Turn it back over to Dan.
Yeah, can you hear me, Wolf?
I sure can.
Okay, good. Okay, I got a couple questions, and then I know a few of these are kind of the same, so I'll go from there. But yesterday, one of our newest members, and we have gotten a lot of new members since the last time you did this, probably 30 or 40, and we're getting a lot more global members. Anyway, it said in the January 29th, you mentioned the board are considering the implementation of a share return policy. And he said, where does it stand? But I would say, let's say oil averages over 80, and you know you're going to generate a lot more free cash flow than your current budget. Is that the determining factor on when they might start something?
Yeah, I mean, we'll discuss it on a quarterly basis. The plan for the board is to discuss it on a quarterly basis, see where we are, look at our projections, our forecasts, what we want to do. And, you know, our forecasts right now are that we spend less CapEx than we're making for the year. And so, you know, especially with our share price down below where we think we should be trading, I think it makes a lot of sense. So, you know, Gary and I will, I'm sure, be recommending that we do this when we find it financially prudent to do so. And hopefully that's later on this year. That's the goal. And that's, the board is all on the same page for that.
But they're not considering issuing more stock or something to like accelerate the drilling program or anything like that, are they?
No, I think it makes sense to do what we're doing. I think you know, a growth going forward in a measured fashion is the right way to go. But oil prices being higher, we accelerate the growth more as well, right? So oil prices our assumption is a $72 oil price. We think this makes sense for the company without, you know, taking on more debt. So you know, when let's put it this way, when the stock price is down, you don't want to issue shares, right? So
Yeah.
And we don't want to take on a ton of debt, although we're down, our leverage ratio is excellent. So we could take on more debt from that point of view. Which, you know, if the share price is down and we wanted to accelerate, you'd probably take on a little bit more debt rather than issue share price.
Right.
And issue shares, at least that's my opinion on it.
Yeah, I agree. I know the last few wells that you completed came in at 25% lower completed well cost. I think that's a really big deal. So for an average Caney well, what oil price is needed to break even now with that lower well cost?
You know, I haven't looked at our latest economics because we're just in the middle of our reserve report. So what I'd like to do is generally look at what Netherlands Sewell assumes that we're going to be able to do, to quote that. So that's a third party doing it, not us internally. But it's quite low. I mean, back before we started drilling in 2022 again, we were looking at an oil price at about $65 a barrel. And at that point, we felt like it really made sense to drill wells, and we weren't making wells that were as good as the wells we're making now. So that's one thing I can clearly say is, you know, even at a $65 oil price back, you know, 2 years ago before we had our drilling efficiencies and our completion efficiencies that we have now, it made a lot of sense. We were getting good rates of return. We were expecting good rates of return, I should say, from these wells.
Yeah. Well, I can tell you, if you got a $45 net back, that's pretty darn good. Okay, couple questions from looking at your January press release. I have the surrounding wells that were impacted by the fracture stimulation of the 3 Emery wells. Have they fully recovered?
So I haven't looked here in the last week, but yeah, they were all coming back up. They probably aren't fully recovered yet. The wells that we shut in from like freezes that didn't have any impact from the offset wells, those all came back up quickly. Some of the other wells are still dewatering. We figured it would take a number of months. Our guess was 3 to 4 months to have them fully back up again to full recovery. So they're not entirely there yet, but
So
a good portion of them.
Yeah, the Tishamiya field, though, it was producing 3,800 BOE per day before the January freeze. So it's almost back to that now.
You know what? I can't quote on this because we also have natural declines that are going on at the same time, right? So you have some natural declines going, and then you have some recovery from wells. Yeah, like I said, we can only comment on what we put out there. So you do have an offset of what's going on.
Yeah, I noticed on slide 11, if you go back to slide 11, when you said you weren't drilling any new wells, it looked like the decline rate was really low. I mean, if that's all it was going down. I mean, prior to that,
right?
Yeah, back in
right
this,
here,
you got a really low decline rate.
Yeah, then that's a few years out, right? So let's see, we started drilling in 2022, so 21, 2019. So our last wells were at the end of 18. So
okay,
that's
and were these vertical wells?
2 years after that. No, these are all horizontal still. All horizontal wells, yeah. So that's one of the reasons is Netherlands Sewell kept increasing their EURs every year, right? Because you have your harder declines in your first couple of years, but once you got out 2-3 years for us, our decline was, you know, not very steep anymore. So
yeah, that's good
reservoir quality.
Okay. And can you once again say that you're going to complete probably 7 wells, you think now? 7 wells if the oil price holds up. When do you think those wells will be turned to sales?
It'll depend on, you know, exact timing on the drilling rig and the completion activities, right? So those last wells will be are planned right now for sometime in the fourth quarter.
But the first 2 wells are going to be completed in a couple months, right? In the middle of the second quarter.
Yeah, the first 2 wells. Yeah, sorry, I thought you were referring just to the tail end of the wells. Yeah, okay. The first 2 wells will be in the second quarter is the plan.
So you get a little production boost at the end of the second quarter, but then the big production boost will be in the fourth quarter.
Correct.
So you think the plan?
And hopefully earlier in the quarter than later in the quarter, but like I said, we'll fine tune that as the year goes on.
Okay. So hopefully, because I got on my forecast to get to the midpoint, I've got a pretty good bump in production in the fourth quarter for that. So, all right, let me look at the ones and no, my cursor over here. Here it is. Put your hat on. Got too big of a screen. Okay. Okay. Okay, current budget based on $72. How much free cash flow could be returned to shareholders via buybacks or dividends this year? Pretty much at 72. You're using most of the cash flow, aren't you, for drilling wells?
No, let's go
Got
to
a little
here's the
free cash
forecast,
flow?
right? So we've got adjusted EBITDA of 46 million versus our CapEx 33 to 39 million.
Yeah, okay, so you're looking at about
So it's
10 or 12.
7 to 7 to 12 is about right.
Yeah. So either you're gonna pay down debt or drill another couple wells or start a dividend program.
Yeah,
Yeah.
exactly. So
Okay, do you
It's
expect
a little tighter than that because some of the CapEx for 2023 we paid in
that's
January. Right. So it's a little that difference is a little less than the forecast shows, just because the timing of the cash.
Yeah, but with that pause in drilling, you're going to kind of build up you'll have a lot of cash in the bank to pay that last group of wells, I would think.
Yeah, I mean we're looking at year-end debt to be in that 25 to 27 range, right?
Okay.
So
okay, do you expect a significant increase in your PDP reserves in March when you get the new reserve report? You hope so, I guess.
yeah, I mean I would assume so.
Yeah,
I would assume
a bunch of good wells.
Our PDP on the BOE goes, right? So yeah, on a BOE basis, it should bump. So
and
we'll
then
see how much it bumps when they're done with it.
And then when do you meet with your bank for to see if you get an increase in your possible credit line, even though you say you're not going to need it to draw?
Yeah, once the reserve report is out, then we turn that over to them, and then it's usually within, call it 60 days or so.
Yeah, he asked, could you see an increase in drilling program back half? Well, that's probably based on where are oil prices.
Correct.
Yeah. Now, all my forecasts are assumed that we're at 82.50 for the second half of the year. I think we're going to get pushed past 80 here in the second quarter. And obviously, if we have any conflict directly with Iran, it's going to go a lot higher than that.
Yeah.
Okay, Dale asked, what are the plans to prove reserves in the probable and possible categories? Can any comments be made on contingent resources?
It's something we will look at, and if we add additional wells, sometime the next year, management's plan is to drill a well in some of those other areas.
So is the plan now to like move the drilling, like move away from existing wells so you don't have the interference?
We'll still be near additional or existing wells in general, but it's going to be minimizing that. It's more in grouping in an area, letting those produce for a while, then going into a different area, moving those. We will continue to have some impacts, and those are into our modeling now.
Yeah. Well, I do think
it's hard not to do that. So, but hopefully these wells all recover within 3 to 4 months in general. Mm-hmm. And so, you have a dip down and that comes back up again to those levels. But you don't want to hit all of them at the same time. So that's kind of why we're trying to group things together. So you don't want to hit and re-hit wells.
Yeah, I think it's really important and a real plus that your entire acreage position is close to sales lines, that you don't have to, figure out how to truck something miles away or something. Anyway, year over year, the stock price has gone from 441 to 325. But any insights on why the stock price is down?
Yeah, the market sentiment hasn't been great.
Yeah,
it's just, we were also, we were originally primarily listed in Canada. And if you look at Canadian oil stocks, they got hammered last year. And we performed much, much better than the average, than a lot of, I'll just say, I don't have the exact stats, but a lot of what I would consider our peers. And so, we were just drawn down alongside that as well. And, we're trying to expand, getting more shareholders in the US. So along those lines, we listed on the NASDAQ last year. So we're looking to get more and more US shareholders and expose more and more people on the US side of things to this story, because I think we're very underrepresented there. Top of that, we'll actually qualify to be on the Russell this year. So they'll announce when that qualification is, but it's generally, in March, April. And then they announce it in, I think, May, June-ish.
Yeah.
But you know, hitting the Russell index creates more liquidity, creates more volume, trading in general for companies once they get listed there. And we, like I said, we weren't listed there before that, and so we're making a bigger push in the U.S. side of things, get more shareholders in, etc.
Yeah, that'll help. Well, I think, you know, a good year-end reserve report, I think when you can report that the production has bounced back from the January freeze, I think that'll be a plus. You know, then, you know, you get those two wells completed in the second quarter. If they come on as expected, I mean, you got some catalysts that are coming up here in the near future, I would think.
Yeah, and the more wells we drill, the more we convert our proved undeveloped reserves to proved developed producing reserves, right?
Yeah.
And then people will start realizing that this is just a manufacturing process. It'll be more cookie cutter to, you know, convert these reserves. And you know, everyone in a down market, everyone looks at just what your proved developed producing is.
Yeah.
But when you have really, really low risk reserves and you're proved undeveloped, those don't get noticed right away, right? And so
Yeah.
those that realize that those are going to be converted, those are the ones that usually win by buying stock when it's cheaper. And then hopefully everything goes that way, they convert and everyone goes, oh yeah, this should be worth this rather than this.
Yeah,
That's kind of
I think
a simple version of it.
Yeah, and in, you know, for small caps, whenever you have any kind of operational issues, like, you know, it took you longer than expected to get those wells at the end of last year completed. I think anytime you have something like that, it's kind of like investors think the worst or something. I don't know,
Right.
but it's just,
No, that's right.
You got to
I mean, we
regain
don't
their
see,
confidence with it.
yeah, we see no difference in what we're doing. You know, still executing and seeing good reserves. You know, we're still pulling a lot of oil out of the ground, and there's a lot of oil to be pulled out of the ground here, in our opinion.
Yeah,
And
are
obviously
you
everyone's sills too.
so you're planning on getting out more to, you know, talk to potential investors and stuff, doing more presentations and
Yeah, yeah, we're looking to more on the U.S. side of things, basically. So we
Yeah.
did some, you know, Canada in general more in the last, you know, 2 years once we started drilling again, and now we're looking to do more in the U.S. That's why we listed on the NASDAQ as well, because
Yeah.
a lot of people couldn't, you know, a lot of brokers can't recommend our stock if you're not listed on a primary exchange in the U.S. I'm talking about U.S. side of things, right?
Mhm.
So if you're on where we were on the OTC, and a lot of brokers can't recommend that to their clients. And so being on the NASDAQ or the NYSE, obviously, either one would helps you be, you know, what the powers that be deem to be a legitimate company, even though the company hasn't changed. We've been legitimate for a long time, right?
Mhm.
So
Yeah, are you going? There's a conference coming up down in New Orleans, I think, that Petrie does. Maybe, are you going to that?
we'll most likely be there, yes.
Okay, that's a good one. That'll get you some nice exposure. Why is it NAV so much lower than your peers? Well, I mean, I think we've talked about that. I plan to change the market perception. Yeah, I mean, you just got to get out and keep telling the story.
Yeah. I mean, we're not a
Dale, I'll tell
complicated
you, you gotta
story,
keep
right?
doing it. That's why we're doing this webinar, dude.
Right.
Anyway, and I will tell you, our webinars, you know, I think there's 45 or so people on this call today, but we do record these and we send them out. And some of these webinars that we put out there have gotten over 1,000 views. And you know, if you guys want to send it to your friends, the recording, that's fine too. I don't care. It helps us get more exposure for EPG. I think we talked about the dividends. I think that's going to come later in the year. T-zone wells. Yeah. So has your perception of the T-zone changed, or you're just kind of putting it off till you get a chance to really analyze the data from that batch of wells and stuff?
Yeah, we want to double check, I mean, what we think is going on right now, but we think in some parts of the field, you know, that there is a barrier between the two. But when we fracture stimulate, it in some areas of the field is a little bit more broken up, so it can contribute fluid up into the Caney. And so we'd rather not have that interfere with the Caney. And if we can figure out what parts of the field really don't have interference, we'll be drilling some T-zone wells in the future at the same time as Caney wells. But it might be the lowest risk thing for us to do is just come back later and then drill some T-zone wells, you know, once, you know, production is settled in at a lower level from the Caney. You know, you've made your money back out of those wells, production's down lower, it has less of an impact if you do push water up into the Caney.
Right. Okay. Yeah. Anyway, I mean, I'll just tell everybody what you can close with this, that, you know, with small caps, and I've been doing this a long time, you know, you'll find them and they're trading it like a ridiculous valuation. And then suddenly somebody figures it out. And, you know, it may just be one hedge fund that decides to get a position in, and then they tell their friends, and you know, the next thing you know, it takes off. So we've seen that with Hemisphere, In Play. You know, those things went up 400 or 500% in like a year once they kind of got discovered. And you guys are really in better shape. I mean, you're not having to borrow money to do it. You got a strong balance sheet, got a low you know, debt ratio. Everything looks good on the numbers. And for those on the call, I will be updating my forecast model a little bit after this, and you can pick it up on the EPG website this afternoon. I'll up it there. So anyway, Wolf and Gary, thanks a lot, and I think this was worthwhile to do this.
Yeah, thank you, and thank you everyone for watching. Appreciate it. And,
All right.
Yeah, thank you.
All right, thanks a lot. Sabrina, you can end this, and we'll send out the recording this afternoon.